Business analysis. Do you want to know how to do it? So let's begin with the example of fine organics. A business analysis, I generally like to divide it into three parts. First part is the basic financial ratios that are there. I have a list of 20 of them, and we will go through first 5 and 6 and see if they are very good and in line with what we want. Then I have the second step, which is the size of the opportunity, management, how they are doing it, how well they are poised to take up the opportunity, are they going too fast or too slow, and things like those. Finally, the third stage is the business itself, how the business has a moat around its competition, uh, what are the uniqueness of the business, how the business is has developed its USP or unique selling proposition, what are the entry barriers and things like those. So this will be a long video and we will divide it into a three parts. So let's begin the first part. The first part of business analysis is looking at some financial ratios. So this can help us reject some of the non-performing or not so good businesses. I have kept this as a first part because there are many companies listed in National Stock Exchange and BSC and NSC, and we don't want to be taking all of them and doing a very detailed analysis on them. So first stage is we look at some ratios. I will go through 5 or 6 of them for fine organics and see if it passes all of them. I have done this in the background and it passes most of my ratios. So let's deep dive into the ratios first. We go to screener and look for fine organics, and first of the first ratio that we look at is ROC. Yes, it's above 38% or but we look at the consistent ratio, and yes, it is above 20% consistently for the last 5-6 years, and so ROC is good enough for the business. Then we look at debt to equity ratio, very low debt, perfect. Then we have operating profit margin. So let's look at operating profit margin. Yes, it's consistently around 20%. So sometimes it goes to 22, 23% and then 17, 19. And last trailing 12 month, it's around 26%. And the last year has been very good for the business. So the OPM has increased, but we expect it around to be 20%, which is good enough. Then one of the important thing is how the business has cash flow compared to its profits. So let's look at the profit and loss statement, and we see that in March 2020 it had a net profit of 260 crores, but cash flow was not that good in this month, in this year, and it's because of high receivable and high inventory. Generally, once the cash flows are not good, we have to look for, I mean, one single year is not good time frame to look for cash flows, because they could have certain amount of inventories remaining which they may have cleared in the days or in months after the March. So the best way to look at it is 3 or 5 years time. So let's say if we do 219, 134 and 67, so that's 200, 300, 67 plus 34 is 400, around 420, 430 crores of cash flow is there in the past 3 years. And let's look at the profit and loss statement, and if you look at the last 3 years net profit, it's 165, 120 and 260. So 260, 360, 460, 525 and 535, 545, around 540, and they have 430 crores as cash flow. So yes, they are getting 80% of the cash flow in the past 3 years, so that's good enough cash flow for 3-year average. But still we need to keep an eye on how the cash flow is going, how the inventory is coming down in the coming years. So we see that yes, promoter has good skin in the game, and there are nothing that says that the important aspect is the profit growth. Yes, we see good compounded profit growth of 27% in the past 5 years. Sales growth is also good, and we need to also see if it's a one-off sales growth or they have a consistent sales growth. So in 2020 and 2021, there is no good sales growth, but in 19, 18 and 17 they had a decent amount of sales growth, and then there is a huge sales growth in 2022 because of some restrictions in China, and they had a very good business in 2022. But still, if we look at 17, 18, 19 time period, it's a good sales growth. Around 20% one can say is the good average. So now we have all the ratios of fine organics in place. We move into the second stage. The second step of business analysis is to look at the opportunity size or the sector analysis. The reason I do it is because there are great companies whose all the ratios fit in place, but the sector may not be expanding. I prefer to give an example of Reliance Industries in say 2015-16 time. It was an mainly into oil and gas sector. So oil and gas sector was, Reliance had maximum market share. It was a market leader, but oil and gas as a market or as a sector was not growing at a very fast pace. So Reliance could not grow, or there was not much of a bigger opportunity for Reliance Industries. Similarly, if a company is a market leader, but if the market is saturated or the market is not growing in size, then the company can't grow. So we have to look at the sector as a whole. Fine Organics is into oleochemicals, so it has industry-wide application in the FMCG sector, in paint sector, in packaging sector. Everywhere the chemicals that the Fine Organics is producing is applied. So the sector is growing, the business is growing, and then company can grow much faster than the sector itself. So yes, it's a huge opportunity to grow for a business like Fine Organics. The step 3 of the business analysis is to analyze the business itself on many fronts, and I look at 10 key things into the business first, and then each of those things leads me to something else as well. But it's the first 10 things that we will be discussing right away. First is the pricing power of the business. Can the business pass on the price rise to its customers very easily, or customers freak out when the prices increases, or is the customer looking for an alternative once the price increases? It's very important for me to consider the business for investing, and I like to see how the past in the past company has passed on the price rise. With Fine Organics, I can see that they have a very good pricing power for their business. They are doing much better OPMs, and they are continuously improving the OPMs. So yes, the company is able to pass on the price. Second is entry barriers for new entrants. So how the company, restricts the entry of a new player in the market. The best way Fine Organics does this is because they have a customers where let's say in an FMCG company or a paint company, if the additives are being used and it's liked by the customers, the companies do not want to change the provider of the additives or oleochemicals or food additives, anything of like that sort. So that's a good entry barrier for any new player to enter into the market. As they acquire more and more customers, as they get deeper into the business, as they increase the customer base, the moat will continue to become bigger and bigger. Third is simple business model. I don't like companies who have too many subsidiaries into too many things, because I have a very limited understanding of finance, and so I prefer to have companies who are simple in their business model. They produce the products and sell it. Like they produce the product and then they have two subsidiaries doing the same products and then sell it, and take raw materials from one of the subsidiaries. Once the process become too complex, I generally tend to avoid it. Fourth is growth outlook. We looked at past growth rates, and that was in around 25-26% or 20% growth, sales growth, and 25-26% profit growth. So they were expanding the margins. But can the growth rate continue in the future as well or not? Past was good, but is there a scope for a future growth? And this the growth outlook comes from the sector analysis as well, but can the company keep on growing for an elongated period of time at a very high pace? If the answer is no, I generally am not investing in that company. And for me, that business analysis stops there. But because Fine Organics has a good growth potential as well, we will dig deeper. Operating history. So I don't like to invest in new businesses. New in the sense, not new in the stock market, but who don't have an experience of at least 10 to 15 years. Because once they are into a business for 5, 10 years, then they have seen an upcycle and down cycle. So once they have seen a down cycle, that helps them to learn a lot of things and do things in a very systematic manner. So I like to see operating history of businesses. I mean, they can be new in the market, that's perfectly fine, but they should have some experience of building a business from to a sizable position from a very low size position. So it's not like they can start a business 3 years back and I am interested in it. So I need to see their operating history as well. Number 6 is research and innovation. If the company is not investing in R&D, they can become obsolete in a very short span of time. This is a fast changing world, and I like to see research and innovation spend as a percentage of sales as well. I look into the annual reports and see what is the kind of research, innovation, new products that they are coming up with to make them remain relevant for the next few years. Number 7 is operational efficiency. So how the company is improving its operations to deliver better return on capital, how the efficiency is increasing. You can refer to the ROC video. I will link it in the description as well. So a company can do the same amount of sales and still become a very highly operationally efficient. So once they are doing that, the return on capital increases. They don't need further capital to fund the future expansions and things like those. So I like to see a company doing it over a long period of time in the past, and they should continue doing it in the future as well. Point number 8, sector leadership. I like to invest in a very unique businesses. So they generally are the leaders of their sector, or rather the segment in a sector where they operate. Generally, I don't prefer if there are more than 2 or 3 players in a sector. But if there are players even, then I like to prefer to invest in companies who are sector leaders in that sector itself. Point number 9 is management pedigree. I generally don't prefer to invest in business, but I prefer to invest in teams. So the management, the team that I am investing in should have a very high standards. Fine Organics has a very high standards. So recently in a con call, they said that they will not be able to grow at a much faster rate, or they will not be able to replicate the earnings and growth rate of the past year. And if we see that, it may be true as well, but trying or telling that well in advance made the correction in the stocks come very soon. But that is how the management should be behaving. They should let the shareholders know what is coming. I mean, it's not just that the price of the stock can go high, and they don't let them know about the things that are being developed, or how the things are progressing. It's always better to under promise and over deliver, and I like to see such acts from the management, and that way it gives me much more confidence to remain investor or invest further in the business as well. Fine Organics, if we look if we look at the EPS of the past 5 years on screener, so let's say in 2019, 20 and 21 March, the EPS was around 40 rupees, and then suddenly it jumped to 80 rupees or 84 rupees in 2022, and now in the past 12 months we see that it's close to 192 rupees. And even if they do good in the fourth quarter, it would be around 160, 170 rupees. So again, from 40 to 80 to 160, that's a great jump, and that's why the stock has rallied from 2000 rupees to 7000 rupees. But once the stock was rallying too much, the management came and told that this is not the growth rate that we expect to continue, and there will be a lot of pressure in the coming years, and that has led to the fall in the stock price. I mean, that's the kind of management that I like to see, who are actively telling the shareholders what to expect in the future, so that the share price don't run away too much and then fall too much. Still, the share price has fallen more than 35% from its peak, and that's a good amount of fall. But still, I mean, because management has clarified, the share price will not have too much high and too much low. They are controlling the volatility, because what market expects is that the EPS will double in 2, 3, 5, 7 years times, or each 2, 3 years times. But that may not happen very easily. Even they may not be able to do 170-80 rupees EPS in the next year as well. We will look into the price information a little later. Point number 10 is, I like to see the subsidiaries and related party transactions. I don't see any major thing in a related party transaction disclosure that they have done on page 137 of the PDF or page 153 of the annual reports. And this gives me the confidence to be remaining invested in the business, or consider the high standards of the management as well. And then I also see the audit reports, audit fees of past few years. And I have taken this hint from Saurav Mukherjee, who says that if the audit fees is increasing as per the sales, that's perfectly fine. But if audit fees varies a lot, then you have something that is cooking in the numbers. And once that anything is cooking in the numbers, I generally like to avoid that company. So once I see clean related party transaction and audit fees in line with the sales, I am generally ready to invest in a company. And then comes the price related information. So now we will see, in the past video I have shared how to calculate the fair price, and so first I will use that to find a fair price of Fine Organics, and then come up with, see if we have a value at the current price, why the fall, and is it an opportunity or we should wait. Again, the price information that I'm sharing is not for recommendation. This is just to help you understand what price we should be buying certain business at. So like I have taken this example of calculation of fair price, and I have done this for all my stocks, but we are sharing only Fine Organics related. So we are not taking the EPS of a very high EPS of 192 rupees, but we are only taking it as 84.67, and we expect 20% as growth rate, because that is quite visible from the past as well as the future that I have seen, that 20% is the expected growth rate for the company. And I expect 25% CAGR return from my investment with a margin of safety of 20% and P ratio of 60, at which I should be able to sell this stock after 10 years. And I see that it's pretty much possible, because this company has traded in range of 70 to 80 P for a very long time, and now it has corrected because of the management commentary that we have seen, that such a high growth may not be possible of 50-60% in the coming years. So now we see that the earnings keep on growing from 84 rupees to 365.25 rupees, and then at 525 rupees, if we are able to sell at 60p, the price should be 31,000 rupees, and then we backtrack at 25% CAGR, and we get that with the margin of safety, or the share price should be 3300 rupees, and then with a margin of safety of 20%, the price that we should be investing in Fine Organics should be around 2700 rupees. This is just a rough calculation to help us understand at what price we should be buying it. Again, the stock has corrected from 7,000 rupees to 5,000, or under 5,000, 4,500 rupees right now. And the main reason is because the management has given a commentary that such a high growth rate will not be possible. And so If you think that whatever management is saying and the pain that the management is saying will remain for a short period of time, then there should be a good buying opportunity. But I think there is more downside right now because market is correcting, and as well as the management has alluded that the growth will not be very high. So it's better to wait and see what is the kind of growth that the company is able to generate in a normal circumstances when China opens up and everything is normal, and then decide if you should be investing in fine organics or not. I hope this helps you understand how to do business analysis. This is not an investment, or you should not consider this as an investment advice, but this should help you to understand the way to do business analysis.